Today I'll be explaining on MFRS 8 operating segment, which guides how a company should report information about different part of its business and its financial statements. What is an operating segment? First, an operating segment is basically a component of an entity that meets three conditions. It engages in activities that either earn revenue or incur expenses. The result of this component are regularly reviewed by the Chief Operating Decision Maker or CODM to make decisions about resources or performance. And lastly, discrete or separate financial information is available for that segment. This means that the segment must be meaningful enough for management to track and access. So this is the objective of the MFRS 8. The objective of the standard is to ensure that the entities disclose useful information so that the user of financial statement can understand three main things: the nature of each operating segment, the financial performance of each segment, and how the company's resources are allocated and how performance is assessed. So basically, MFRS 8 help outsiders understand how management views and run the business internally. Next, not every operating segment needs to be reported separately. A segment becomes reportable if it involves a specific product or service that is significant and represents a distinct business activity. For example, if a company has a construction division that is large enough, then it must be disclosed as its own reportable segment. So the importance of MFRS 8. Finally, MFRS 8 enhances transparency. It does this by aligning external reporting with how management internally analyzes and monitor the business, so investors and users of financial statement get a clearer and more accurate picture of the company's operation.
Now we look at the Chief Operating Decision Maker, also known as the CODM. Under MFRS 8, the Chief Operating Decision Maker or CODM refers to the person or group in an organization that is mainly responsible for deciding how resources are distributed to different business segments and for reviewing their performance. This role is very important in financial reporting under accounting standard. The CODM does not need to be one specific person with an official title. Instead, it represents whoever is involved in making major operational decisions. In many companies, this role is carried out by the CEO, but it can also be performed by a team of executive directors or another decision-making committee. At Hextar Global Berhad, the two main decision makers are Madam Lee Choi Keng, the Group Managing Director, and Mr. Reben Azhaban Ali, the Executive Director. They work together to lead the company. Their main responsibilities are to oversee the company's operations, make important strategic decisions, and ensure that every business division perform well. They also monitor the company's progress and support growth and also improvement across the group.
Now, I will explain about types of segmental report of Hextar Global Berhad for financial year 2024. The company operates through several business segments: investment holding segment, agriculture segment, specialty chemical segment, and fruit segment. In 2024, the group recorded total revenue of 918.3 million ringgit. These figures include both sales to external customer and inter-segment transaction within the group. Here is revenue contribution by each business segment. We can see in investment holding segment, RM 119,440 for external revenue. Most internal charges originate from this segment. For agriculture segment, 313.2 million ringgit external revenue. This is one of the major contributor. Specialty chemical have 421.4 million ringgit external revenue, the largest contributor, making up nearly half of the total company revenue. And for the last fruit segment, RM 183.5 million ringgit external revenue. After eliminating all intercompany transaction, the group net revenue stand at 918.3 million ringgit. For geographical segment, we have local and export. Local revenue increased significantly from 497.2 million ringgit in 2023 to 685 million in 2024. For export revenue, it also grew from 171.8 million ringgit to 233.3 million ringgit. This reflects strong growth in both domestic and international market.
According to MFRS 8, an operating segment must be disclosed when it meets any one of the three quantitative thresholds. First is the revenue test. A segment is reportable if its total revenue is 10% or more of the combined revenue of all operating segments. Second is the profit or loss test. A segment qualifies if the absolute amount of its profits or loss is 10% or more of the total profit of profitable segments or 10% of the total loss of loss-making segments. Third is the asset test. A segment is reportable if its assets make up 10% or more of the combined assets of all operating segments. A segment only needs to meet one of these three thresholds to be classified as a reportable segment. Hextar Global Berhad determines which operating segment is reportable using the profit or loss test. Segments are reported when their profit or loss contributes at least 10% of the total combined profit of profitable segments or the total combined loss of loss-making segments, consistent with how the CEO evaluates segment performance. The first key benefit of segmental reporting is better risk assessment and forecasting for financial statement users, especially creditors and analysts. Segmental disclosure shows details like asset concentration, geographic exposure, and cash flows for each business segment. This helps users identify where business risks exist, such as seasonality, reliance on commodity prices, or high capital expenditure. With this information, lenders can set loan price and covenants more accurately based on which segment owns the most asset or generates the strongest cash flows. Analysts can also make better forecasts by estimating revenue growth and profit margin for each segment instead of using only total figures. Based on the evidence 1.1, Hextar's Global Berhad segmental report shows a clear geographic revenue split. Local revenue was about 685 million ringgit, while export revenue was around 233 million ringgit. This helps users assess whether the business is more exposed to domestic demand or international market risk.
So the second key benefit of segmental reporting for financial statement user. It is increased transparency and accountability. Segmental reporting makes the financial statements clearer by showing how each part of the business performed instead of only giving overall totals. This helps users to see which segment are strong or weak. It also holds management accountable because stakeholders can compare segment result with how management allocates resources and make decisions. With these extra details, it becomes harder to hide poor performance and easier for users to understand how well the business is being managed.
Now, what is MFRS 134? MFRS 134 is a Malaysian accounting standard that governs interim financial reporting, which refers to quarterly or half-year financial statement. The purpose of this standard is to ensure that companies provide timely, reliable, and relevant information between annual reporting date. Under MFRS 134, companies must prepare condensed financial statement and they must use the same accounting policies as their annual financial report. The main objective of MFRS 134 is to help users such as investors, lenders, and analysts to understand how the company is performing throughout the year. It improves transparency by highlighting changes that would not be visible if we only rely on annual report. These include things like major investment, acquisition, joint ventures, impairment, or changes in capital. The first significant event I have found in the interim reporting is new joint venture agreement. On May 2024, the company's indirect 51% owned subsidiary, Durian Global Sidang Berhad, had entered into a joint venture agreement with Shenzhen Yosender Investment Company in China. The purpose of the agreement is to expand their durian boat business in China. For financial effect, expected to increase future revenue from the China market and also has potential changes in segment reporting and group structure and may improve long-term profitability and international growth. The second significant event disclosed by the company is the payment of an interim single-tier dividend of 1 cent, which amounted to 38.8 million ringgit paid in April 2024. This is significant because it caused a large cash outflow, reducing the company's liquidity. Also, it reduced retained earnings in equity. It also affected the company's financial flexibility and also its senior management confidence in the company earnings performance. Under MFRS 134, such a large dividend payment must be disclosed because it directly impacts the company's financial position.
Next, let's look at the reporting period for the current and comparative financial statements of Hextar Global Berhad. The current reporting period for the statement of financial position covers from 1st January 2024 to 30 June 2024, while for the statement of profit or loss, it consists of an interim period from 1st April 2024 to 30 June 2024 and a cumulative period from 1st January 2024 to 30 June 2024. In comparison, the comparative reporting period for the statement of financial position is 1st January 2023 to 31st December 2023, and for the statement of profit or loss, it includes the interim period from 1st April 2023 to 30 June 2023. And the cumulative period from 1st January 2023 to 30 June 2023. Overall, the table shown highlights the time frames used to compare the current year against the previous years, enabling users of financial statement to analyze the company financial position and performance across different periods.
Moving on to the comparison between the current and comparative reporting period for two financial statements, the statement of cash flow and the statement of changes in equity. First, for the current reporting period, the statement of cash flows cover from 1 January 2034 to 30th June 2034. This is the current financial half year we are reporting. Next, for comparison purposes, we use the previous corresponding period, which is 1 January 2023 to 31st December 2023. For the statement of changes in equity, we need to present two views. The interim period, which is 1 April 2024 to 30th June 2024, and the cumulative period, which is from 1 January 2024 to 30th June 2024. This follows the MFRS requirement that interim report must show both the quarter and the year-to-date movement. For the comparative section, we also show the interim quarter for the previous year, 1 April 2023 to 30th June 2023, and the cumulative comparative data 1 January 2023 to 30th June 2023. This allows stakeholders to compare both quarter-on-quarter and year-to-date performance. So overall, this structure ensures that user of financial statement have a consistent basis for comparison between the current reporting period and the previous corresponding period, especially in interim reporting.